Hello and welcome to Morningstar. I'm Emma Wall and I'm here today in London at the Morningstar Investment Conference to talk to J.P.Morgan's Karen Ward. Hello, Karen.
Morning.
So I've just listened to your presentation. I thought we could focus on the US. There's a very interesting slide that showed the disassociation between growth in the US and the amount of spending that is about to be done.
Yes, exactly. So the US administration's announced not only an enormous government spending package, but obviously this great big tax reform. That's going to push the budget deficit towards around 5.5% over the next 2 years. But I think what's complicating the issue for markets is, whilst this sounds great, that's more growth, we have never seen a fiscal stimulus of this size at a time when the economy is already doing very well, when unemployment's already low. So it raises so many interesting questions. How is this going to prolong the US economic cycle? It might mean that actually it gives us another couple of years of very strong growth. If we see productivity come back, if we see that participation rate in the labour market continue to rise, then that will actually come through in additional growth, which is obviously great news for markets. At the same time, there is a risk that it turns up in inflation. And of course, what that means then is, whilst the US administration are giving with one hand in fiscal stimulus, the Federal Reserve will be taking away with the other hand in higher interest rates. So that's why the market's a bit schizophrenic about how to interpret this additional stimulus.
And you said the key Fridays to be watching were the jobs figures, because we've already seen it this time, this year. We saw the jobs figures be better than expected, and the whole world went into meltdown for a few days, didn't it?
Exactly. We saw wage growth pick up 1 month to 2.9%, just a 0.3 percentage point increase. I mean, pretty modest, still low by historical standards. But at the same time, the US 10-year rose 30 basis points, the equity market was down 10%. So this sensitivity to higher interest rates, what that means for stocks is absolutely acute. And we're just going to be watching that payrolls number each Friday to see what extent wage growth is actually coming back. And as I say, whether this stimulus is showing up in growth, good, or showing up in inflation, not so good.
And why do you think it caused such volatility? Because you've mentioned the US reaction, but it wasn't US-centric. You know, I'm based in Hong Kong, the Asia markets fell considerably, European markets fell considerably. We know that this is an unnaturally low bond environment, and yet the idea of bond yields rising is still quite shocking.
I think you're right, that there is this, I think, a gut feeling in many investors' minds that when the central banks were pumping money in, markets went up. So therefore, if the central banks are taking money out, markets will go down. And they sort of can't get over that idea that that's the relationship. But, you know, I think we've got to remember that the reason the central banks were operating so aggressively is the natural spirits in the economy were non-existent. Companies, households were not willing to spend, and they were being forced to through lower interest rates. So for me, an environment where those animal spirits are coming back, where households and businesses want to spend, fine, we don't need low interest rates. The economies and therefore earnings and therefore the stock market should do perfectly well in that environment.
Karen, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.